Hey everyone, welcome back to Crypto Philly, the podcast that breaks down crypto, taxes, and Web3 without the jargon. I'm your host, Sean from CoinFlask, and today we're digging into the tax maze of crypto staking and mining. Whether you're validating blocks or just locking up tokens to earn rewards, it's crucial to know what Uncle Sam expects from you. So let's break it all down, nice and easy. First up, let's quickly define the two. Mining is when you use computing power to validate transactions on a blockchain. Think Bitcoin. You get rewarded with new coins for securing the network. Then we have staking. Staking, on the other hand, is more about holding than hardware. In a proof of stake system like Ethereum, you lock up your crypto to help validate blocks. In return, you earn rewards, sort of like earning interest. But here's the catch: both activities are taxable, and they're taxed differently, depending on how and when you receive your rewards. Let's start with mining. If you're mining crypto as a hobby, maybe with a home rig and no formal business, the IRS still considers those mining rewards as ordinary income. That means you owe taxes the moment you receive the coins, based on their fair market value at that time. So if you mined 0.01 Bitcoin when Bitcoin was $50,000, that's $500 in income, even if you didn't sell the coins. Now, if you're mining as a business, meaning you have equipment, maybe an LLC, you're trying to make a profit. Then you can deduct expenses like electricity, gear, and even your internet bill. That might sound like a good deal, but the flip side is your income gets hit with self employment tax too. That's around 15.5% on top of income tax. So you might reduce your taxable income with deductions, but you're still on the hook. Now let's talk staking. This one's more controversial, but here's the current IRS stance. Staking rewards are taxable income when you receive them, not when you sell. So if you earn 2 ETH from staking and ETH is worth around $2,500 at the time, that's $5,000 in ordinary income. And yes, you when you eventually sell that Ethereum, you'll trigger a capital gains tax based on whether it's short term or long term. So, in the end, you're taxed twice. First, income tax when you earn the staking rewards, and second, capital gains tax when you sell those same coins. Ouch, right? The tricky part in all of this is timing. Crypto staking rewards often trickle in daily or even hourly. If you're staking with a protocol that pays you every few seconds, imagine trying to record that exact value of each micro payment. This is why using crypto tax software is basically a must. They automatically track every transaction and calculate fair market value at the time of receipt. Also, don't forget, mining or staking rewards go on Schedule 1 or Schedule C, depending on whether it's a hobby or a business. You may also need to file Form 8949 for capital gains when you eventually do sell. And if your total crypto holdings exceed certain thresholds, especially if you use foreign exchanges, FBAR and Form 8938 might come into play. Now, here's where things get spicy. Some taxpayers, especially those staking on Ethereum, argue that staking rewards shouldn't be taxed until the coins are sold. Why? Because they say staking rewards are more like new property and that you shouldn't be taxed until you realize the value. This argument got traction in a 2021 court case with Jarrett versus United States, where the IRS actually refunded the taxes, but without setting a legal precedent. So, where does that leave us? Still in murky waters. Until clear regulations come out, and they are coming, it's safest to report staking and mining income when received. So, to wrap all this up, let's recap. First, mining and staking rewards are taxed as ordinary income when received. If you mine as a business, you may deduct expenses, but face self-employment tax. When you sell those rewards later, you face capital gains tax too. So, accurate record keeping is everything. Use software or a crypto savvy accountant if possible. And as always, consult a tax advisor, especially one who actually understands crypto. Wink, wink, coin flask. If you like this episode, don't forget to subscribe, share, and leave us a review. And if you want to dive deeper into tax topics like DeFi, wallets, or crypto loans, check out our other episodes by visiting cryptophilly.com. So, until next time, keep stacking stats and receipts.